Guys, hello and welcome to today's video. My name is Yaroslav Birchenko. I represent Stratix Finance. Today we're going to look at the Fed chairman speech and have a look at the markets. What are the preliminary actions that we can see before earnings? I'm not giving you financial advice. This is just my opinion. We're just going to discuss the things that we heard the Fed chairman say and how could it impact us in the future. Now for earnings, we are looking at Apple today, Amazon, and Meta. I wanted to show you guys what the graphs look like before the earnings are released. As you can see, earnings have yet to be released, and Apple is trading in the middle of this range. We have dropped down and gotten close to the middle line, and also we are trading below the Bollinger Band on the daily chart. Let's have a look at the preliminary action on Amazon. I wanted to show you a level that we're looking forward to trading. So right around 184, we're looking to take some profit. Right now, if you're looking to get in at this area, I would be careful. Look at a resistance level before you enter right at the top of where we are now. But we do have this bullish engulfing candle, the day of trading today that happened. So this is a precursor to some good results. Also, let's have a look at Meta. They're also about to release earnings. Now, Meta showed a fantastic growth this year. They started at around 87, and we can see the massive exponential growth to 400. So definitely a stock that is doing great things, leaps and bounds in its growth. And if you hadn't had a chance to get in on trading Facebook, you should be biting your elbows at this time. I wanted to show you the trade results for Microsoft. They recently reported earnings. And if you guys have a look right here, the earnings came out, so they were estimated 2.7, came out 2.93, and the revenue was estimated at 61 and came out a massive 62, so almost another billion extra. Now, what does this mean for us? It means that the tech space and AI heavy companies are doing very well. So that's probably why Apple is buying up small AI companies left and right. Also, let's have a look at the SPX. The S&P 500. I wanted to show you the great growth that we're also seeing here and where can we expect to grow in the next little while. So this kind of growth pattern that we have here, consolidation and then the breakout. So if you're trading the SPX, then breakout trades seem to be working the last little while. Now let's get talking about what we saw with the Fed chairman during the speech. The Federal Reserve is focusing on two key elements. First is employment, and second is stable prices. Now, the main thing is that the Federal Reserve really influences a lot of different assets, like bonds, like equities, and that includes stocks and ETFs, its currencies, US dollar, and all the major exotic currency pairs that are intertwined with the US dollar. We also have commodities like metals, oil, soft commodities like cocoa. Then we have home mortgages, derivatives, and banking loans. So there's a lot of different assets that are tied into what the Federal Reserve decides and what their policies are. That's why we spend a lot of time as traders analyzing their words. So let's get to it.
Today, the FOMC decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings.
The rate will be left unchanged. This is good information. They are also continuing to reduce their holdings, and that's a massive amount. The holdings that they're reducing, they number in the trillions. So that reduction will have a ripple effect across all the markets that I mentioned earlier.
Over the past 2 years, we have significantly tightened the stance of monetary policy. Our strong actions have moved our policy rate well into restrictive territory, and we've been seeing the effects on economic activity and inflation. As labor market tightness has eased and progress on inflation has continued, the risks to achieving our employment and inflation goals are moving into better balance.
Our actions moved the rates well into restricted territory. Well into restricted territory, well, that really impacts economic conditions really severely. The current rate is 5.5%, and that's really high. We had Volcker tune it up to 20% in the 1970s. Well, now 5% is restricted territory, yet we're still there. Huh? How does that happen?
Activity in the housing sector was subdued over the past year, largely reflecting high mortgage rates. High interest rates also appear to have been weighing on business fixed investment.
Activity in the housing sector is subdued. So that means any rates, real estate investment trust, any real estate ETF that you're investing in, maybe it was a bad investment, and maybe for the next few months it will continue to be a bad investment. Or it could be a good shorting opportunity.
Over the past 2 years, we have raised our policy rate by 5.25 percentage points, and we've decreased our securities holdings by more than $1.3 trillion. Our restrictive stance of monetary policy is putting downward pressure on economic activity and inflation. The committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25% to 5.5% and to continue the process of significantly reducing our securities holdings.
We raised the rate to 5.25% over the last 2 years, with $1.3 trillion worth of assets sold off. That'll definitely move the market. That'll definitely move prices. So they're going to continue to reduce security holdings. What that means for us is that whatever tendency was growing, they're going to stifle it because they're predominantly selling. And as we remember, during the coronavirus pandemic, they were actively buying up stocks from the market. So just investor grade stocks right off the market.
We believe that our policy rate is likely at its peak for this tightening cycle, and that if the economy evolves broadly as expected, it will likely be appropriate to begin dialing back policy restraint at some point this year.
We're at the peak of the tightening cycle. Wow! This is great information. At the peak of the tightening cycle, that means 5.5 is the max that they're going to raise rates to. Now, this isn't set in stone. It changes from meeting to meeting. But what that means is that we're at the peak, and from now on, it's smooth sailing. Oh, and the sell-off of assets.
The economic outlook is uncertain, and we remain highly attentive to inflation risks. We are prepared to maintain the current target range for the federal funds rate for longer, if appropriate.
Keeping rates there longer. This is one of the main messages that was really pushed across during this meeting, is that they may keep rates up there longer. The forecast was somewhere around the middle of the year, we would see the lowering cycle begin.
Let me say that we have confidence. We're looking for greater confidence that inflation is moving sustainably down to 2%. Implicitly, we do have confidence and has been increasing. So we have 6 months of good inflation data. The question really is, that 6 months of good inflation data, is it sending us a true signal that we are in fact on a sustainable path down to 2% inflation? That's the question.
We have 6 months of inflation data. Let's have a look at what that means. Let me show you guys on my screen what 6 months of inflation data looks like. So here we have the level chart. Here's what 6 months looks like. Uh-oh. From December to January, we had a spike in inflation.
If you take a step back, we've had strong growth, very strong growth last year, going right into the fourth quarter. And yet we've had a very strong labor market, and we've had inflation coming down.
We had a very strong fourth quarter and strong labor market. Strong fourth quarter, strong inflation, yes, for sure, and strong labor market. Okay, so this is something to watch for, you guys. We want to pay attention to the labor market. If the U.S. jobs market starts declining, and that's non-farm payrolls, that's new jobs, earnings. If we realize that the jobs market is going to be one of the key decision points that the Federal Reserve will take in, then that's perfect. We as traders, you as traders, need to pay attention to the U.S. labor market.
We don't look at it as a problem. I think at this point we want to see strong growth. We want to see a strong labor market. We're not looking for a weaker labor market. We're looking for inflation to continue to come down as it has been coming down for the last 6 months. In other words, what we care about is the aggregate number, not so much the composition, but we just need to see more. That's where we are as a committee. We need to see more evidence that sort of confirms what we think we're seeing and that tells us that we are on, gives us confidence that we're on a path to a sustainable path down to 2% inflation.
We're not looking for the labor market to fall back down. So they're really, like I said, they're really paying attention to this market. That would be a red flag. That would be a red flag for them if the job market was to start falling. And that would be a green light for us, signaling that the Federal Reserve is altering monetary policy, and that will have all the outlying effects. If you guys want to pay attention to what those effects are, or you want somebody to help you make sense of them, sign up to the channel and we will gladly help you through this process. So let's continue.
As you know, almost every participant on the committee does believe that it will be appropriate to reduce rates. We feel like inflation is coming down, growth has been strong, the labor market is strong. What we're trying to do is identify a place where we're really confident about inflation, getting back down to 2%, so that we can then begin the process of dialing back the restrictive level.
Every member of the committee does believe that we need to reduce rates. Hey, fantastic. So if every member of the committee, almost every member, agrees that they need to lower the interest rate, then guess what? That bull market might be closer than you thought.
The median participant wrote down 3 rate cuts this year.
You heard it first, out of his mouth. 3 rate cuts. Ooh, fantastic. I like it when he quantifies this information. So 3 rate cuts expected in 2024. Keep that in mind going forward.
Yes, if you think about, in the base case, the economy is performing well, the labor market remains strong. If we saw an unexpected weakening, certainly in the labor market, that would certainly weigh on cutting sooner. And if we saw inflation being stickier or higher or those sorts of things would argue for moving later.
A weakening in the labor market would cause the Fed to cut sooner. When is it time to cut? When the labor market falls. Keep in mind. Let's remember that, you guys.
Do you feel comfortable at this point saying the economy has reached a soft landing, or is that part of looking for more confidence?
No, I wouldn't say we've achieved that, and I think we have a ways to go.
The economy has readied for a soft landing. No, it hasn't. The economy has not had a soft landing.
Growth is solid to strong over the course of last year. The labor market, 3.7% unemployment, indicates that the labor market is strong. We've had just about 2 years now of unemployment under 4%. That hasn't happened in 50 years, so it's a good labor market. And we've seen inflation come down. We've talked about that. So we've got 6 months of good inflation data and an expectation that there's more to come. So this is a good situation. Let's be honest. This is a good economy.
This is a good economy. The economy is very strong. It's good to live in the American economy.
But what's the outlook? That's looking in the review. The outlook, we do expect growth to moderate. Of course, we have expected it for some time, and it hasn't happened. But we do expect that it will moderate as supply chain and labor market normalization runs its course. The labor market is rebalancing, as I mentioned. Job creation has slowed. The base of job growth has narrowed.
Growth will be moderate, he said. Job creation has slowed, and the base of job creation has narrowed. Going back to that graph that we saw of inflation, inflation is rising if all the terms and conditions for a good job market are narrowing. It may not be smooth sailing from now on, you guys, from here on.
Based on the meeting today, I would tell you that I don't think it's likely that the committee will reach a level of confidence by the time of the March meeting to identify March as the time to do that. But that's to be seen.
So what that means is it's to be determined. When will the interest rate be cut? Not in March. We've yet to find out. From the words of Jerome Powell, not yet.
The productivity tends to be based on, fundamental aspects of our economy. Is there a case, will it be the case that we come out of this more productive, more on a sustained basis? And I don't know. What would it take? It would take, people talk about AI, but my guess is that we may shake out and be back where we were, because I'm not sure I see work from home doesn't seem like it's a big productivity increaser. AI, artificial intelligence, generative may be, but probably not in the short run, probably maybe in the longer run. So I'm not seeing why it would, but right now I would say the productivity is kind of what falls out of the broader forces that are driving people in and out of the labor force and activity returning and supply chains getting fixed.
AI will not take us higher, not in the short term, and work from home not increasing productivity. They really don't care about any other aspect of the economy except stable prices and a strong job market. That's pretty important, especially when we realize that their actions have a ripple effect on all those markets. Keep in mind that they're only interested in the job market and price stability. He goes on to explain that inflation is here to stay, that it's not likely that it will be cut down. It's not likely that it will reach the 2% target this year.
But the economy has surprised forecasters in many ways since the pandemic, and ongoing progress toward our 2% inflation objective is not assured. We don't have a growth mandate. We've got a maximum employment mandate and a price stability mandate, and those are the two things we look at. Growth only matters to the extent it influences our achievement of those two mandates.
We don't have a growth mandate, but an employment and price stability mandate. So, like I was saying, these guys, they won't cause the next bull market. That's what I think. They will slowly dissolve their trillions of dollars of holdings as the market slowly grinds higher, and that's what you can see right now. Remember, the S&P 500, the graph that I showed you, the S&P 500 is at all-time highs. So this was the highest point right here in January 2022, and right now we just recently renewed all-time highs. So that's what we're working with. We're super excited that you started watching our analysis. We're going to be bringing you more of top-notch content that will help you to make sense of a crazy world. Please sign up and check back regularly if you want a hand in making sense of all the difficult things that are happening in the markets right now. My name is Yaroslav Birchenko. I thank you so much for your time, and good luck trading out there. Peace!